Throughout history, gold has actually acted better on a relative basis in deflations than it has in inflations. And I say on a relative basis. Now, obviously, the thing about inflation is all prices go up in nominal terms. Mm-hmm. And so we tend to think, the price went from X to Y, therefore, inflation's good for this, that, and the other. But on a relative basis, there are other things that historically have done better during inflationary periods. Oil and gas, for example, real estate depends on what happens to interest rates, of course, collectibles and other things, even some stocks. Stock markets tend to do well at the beginning of an inflationary period until the central banks start clamping down on inflation. So there's a lot of things that historically have done better, but deflation, there's very few things that do well in deflations. And gold historically has been the best performing asset in a deflationary period. And when you think about it, gold isn't meant to sort of go from 100 to 1,000 overnight, like Tesla or Bitcoin. That's not gold's function. Gold's function is as a hedge and as an insurance. And so it's meant to protect us against monetary instability, whether that's inflation or deflation. And I think it performs that function well. Mm-hmm. Right. And also what the response of monetary authorities is. So obviously, if you're in Zimbabwe or in Argentina or in Venezuela, gold does very, very well in local currency terms during those kind of hyperinflationary periods, or in Weimar Republic for that matter. Mm-hmm. But a more moderate inflation, particularly where the central bank tries to, fight inflation, then that's not positive for gold at all. All gold cycles, or most market cycles, have mid-cycle corrections. And if you look at gold, you can look at the 1970s, when gold went from $35 to $850 during that decade. But in the middle, in 75, 76, we had 18, 20 months when gold went from almost $200 back to $100. I mean, it fell by 40% over a period of, as I say, about 18 months. That's a pretty painful correction. Now, what we've experienced so far in terms of length is approaching that. In terms of percentage decline is nowhere near it. I would argue that gold has actually held up remarkably well. If this is a mid-cycle correction, and I think the cycle started at the end of 2015, when gold was at 1045 or 1050. So it's up 70%, 80% since then. I think that's when the cycle started, the bull market started. If this is simply a mid-cycle correction, the depth of this correction is actually very, very modest by historical standards. I think it's just very, very frustrating for investors because the monetary and economic framework is positive for gold. Gold should. Mm-hmm. It's always dangerous to tell the market what it should be doing, but we think gold should be doing well. Whereas in 75, 76, of course, it was a recession. So we don't expect gold to do well in a recession. And you can look at other corrections and you can say, well, that's why gold went down. So that's one thing. I think we're simply seeing a correction, a normal correction from what was, let's face it, an exaggerated move up. From March to beginning of August, 4 months, gold was up, what was it, about 40% in 4 months? The gold stocks more than doubled in those 4 months. That's an extraordinary move that in any market would argue for a pullback or a pause, but gold, you don't expect to go up 40% in 4 months. So I think we've simply got a correction from that exaggerated move. And if you look at gold over the last 3 years, we're still up. I mean, it's still performed well. Not the gold stocks maybe, but gold itself. So that's one factor. The second factor, we talked about the monetary. And the third factor, of course, is that other assets are doing well. Mm-hmm. And so long as there's money to be made in the stock market, in real estate, in Bitcoin, in NFTs or whatever, so other things are doing well, gold tends to fall by the wayside. When other markets start to drop, then, gold acting as a hedge starts to gain attention. I mean, right now you're in a situation where generalist investors, not dedicated gold investors or gold bugs or anything else, but generalist investors are simply not interested in gold right now. They're not hostile to gold. They're just not interested. Mm-hmm. And that's the sort of worst situation, actually. I think that'll change. But at the moment, people simply aren't interested because they don't need to be. Now, I'll just mention, I've been in the business a while, obviously, but, let's go back even 15, 20, 25, 30 years ago, more than that. Every single mutual fund you looked at, whether it was a US value fund or a global growth or a small cap, they all had some exposure to gold. There wasn't a mutual fund around that didn't hold some gold. If you look for the last few years, other than very few exceptions, like the First Eagle global funds, which have gold in their portfolio, with very few exceptions, there's hardly a generalist fund that holds gold. Mm-hmm. I think that'll change, but it won't change until gold moves up to 1900, 2000, and then people decide maybe they should have just a little bit of gold in their portfolio. Yeah. And when things, we always know that even if we don't have a market crash, which will make people turn to gold, we always know that what makes people interested in an asset class is when it's moving up. Nobody's interested when it's cheap. People start to get interested when it moves up. When gold's at 1900 and 2000, and the best performing mutual funds for the last 12 months have all been gold stocks, the board of directors or the board of trustees says to the manager, hey, why don't we own any gold stocks? Okay, I'll put 2% of the fund into gold just to make everybody happy. Mm-hmm. And, as people put 1 or 2% into gold being a very small asset class, that has an enormous impact on gold and on gold stocks. I mean, I think we all know how small the gold market is, but look at Newmont. Newmont, the largest gold mining company in the world, has a market cap under 50 billion. That's less than the daily volume on Tesla. I don't mean every day it trades that, but I mean many days Tesla trades more volume than the market cap of the largest gold company. I looked at the 150 largest gold mining companies in the world. They came to less than 400 billion. I mean, that's tiny. Mm-hmm. Because from Newmont Barrick, you start to go down very, very quickly. You get to the 10th, you get to the 15th largest gold mining company in the world, you're talking about 2 billion. And you get to the 20th largest, you're talking 500 million. You get down very, very, very quickly. Mm-hmm. So, the gold sector is just a very, very small one. And Doug Casey likes to talk about, the Hoover Dam, water in the Hoover Dam going into a garden hose. That's what it'd be like when funds, institutions decide to put 1 or 2% of their assets into gold. The only sector that's priced accordingly are the scams and the frauds, or the promotions. Let's be nice, the promotions. I think that's not true, actually. The large royalty companies are generally pretty well priced, although that doesn't mean I don't like them, mm-hmm. Right? But no, I think across the spectrum, most gold stocks are not only undervalued, but they are incredibly undervalued. And, you look at the senior gold stocks, for example, Barrick, second largest gold mining company in the world. Or look at the XAU, because that combines, we can't point to one particular factor with one particular company. The XAU on a valuation basis is trading in the lowest 25 percentile of valuations on pretty much every metric. if you look at price to, for the last 20 years, this millennium, if you look at price to EBITDA, it has never traded at lower multiples, never. That simply doesn't make sense when gold is at more or less 1800, when the inflation is moving up, when the monetary environment is where it is, the economy is hardly, rocking and rolling. Gold should not be trading, gold stocks should not be trading at their lowest multiples for decades at this point. Now, you can go further down the food chain, of course. Some of the smaller producers, the single mine producers, the smaller cap, the growing producers, they are very, very attractive takeover targets because, as we know, the big companies are going to have to just step up to the plate with their. We've seen a few mergers of equals and large companies merging. Now we're beginning to see companies acquire, these mid-tier and intermediate producers. We're just going to see more and more and more of that. So if you have a company with an attractive asset, like Pretium, for example, which was just acquired, but if you see a company like that, an asset like a company with one good asset, it's going to be acquired at some point. And then, of course, the exploration companies, that's how we find new assets, is by exploring. And those things are just incredibly undervalued right now. I think there's going to be, so what am I doing? Well, the first thing I look at is if gold starts to move, we know that the major producers are the more certain to move and the first to move. We could buy 5 of the big companies, Newman, Barrick, Agnico, Kinross, whatever. Goldfields. You could buy 5 of the big companies, and if gold goes to 2,000, you can be pretty darn certain that portfolio of 5 companies will move and move well. You could buy 5 exploration companies, and you couldn't be quite so certain that they will respond. Mm-hmm. So the seniors are the first to move and the more certain to move.